6 retail REITs on SGX, 1 sector label, and a 1-year performance gap wide enough to make the entire category almost meaningless. I'm Iggy. I run the numbers on SGX stocks so retirees don't have to guess. If you hold retail REITs for quarterly income, looking at sector averages will mislead you this year. Looking past the headline averages shows 6 trusts with almost nothing in common. Some are posting solid operational numbers, one just changed its name entirely, and another only makes sense once you separate unit price from cash payouts. A major rename happened quietly on the exchange this March. Lippo Mall's Indonesia Retail Trust is now Landmark REIT, trading under the same SGX code with the exact same underlying assets. Companies do not typically rebrand during a strong run. This counter has traded in the sub-cent to low cent range for most of this year, down from levels several times higher not long ago. The trust halted distributions on its perpetual securities in December and launched a 63 million Singapore dollar rights issue the same month. 2 capital preservation moves inside the same few weeks point to something more structural than a rough quarter. Why would a REIT change its name? I raised the question of why a trust would bother changing its identity. Looking closer, that is not far off and not dishonest either. When a brand has taken this much damage, from halted payouts to a rights issue in the same month, a fresh name is at least an honest admission that the old chapter is over. The simpler question for any holder, would you still recognize this counter if it changed its name tomorrow? Because apparently, sometimes they do. The verdict does not change because the bill needs paying. No one pays me to soften a negative call on a popular trust. Most finance channels rely on sponsorships, affiliate kickbacks, or subscriber sentiment, which creeps into their verdicts. This channel remains a personal project, meaning a poor balance sheet gets called out directly every time. For Iggy's elite investors gives you direct access to 0-day forensic breakdowns, the full red zone watchlist, and institutional-grade cheat sheets. For $12 a month, less than 2 copy and Kaya toast sets at Raffles Place, you get the analysis ahead of public release and keep this research completely independent. Check the link in the description. When price and payout diverge, CICT shows what is happening beneath the ticker. Its unit price drifted lower over the past 12 months, but its first half distribution per unit climbed 10.2% year-on-year, a real confirmed increase, not a one-off. Gearing is comfortably low for the sector. Occupancy sits above 98%, and the cost of servicing its debt has actually come down. Improving operational numbers can still see a falling unit price when benchmark yields shift. Rising government bond yields in Singapore and the United States continuously reprice real estate trusts across the board. This price drop reflects broader macro valuation pressure rather than internal business deterioration. The trusts posting positive numbers this year are operating in entirely different jurisdictions. United Hampshire US REIT and BHG Retail REIT both sit in positive total return territory, driven by their respective US and China regional stories. Treat these specific figures as a starting point rather than gospel. The data is a few months old and has not been independently rechecked the way the numbers above were. Sitting in the same positive performance bucket does not mean they share the same drivers. One is tied directly to US consumer conditions, while the other depends on domestic Chinese retail spending. Neither counter reflects local Singapore retail conditions. This one genuinely surprised me. The performance verdict on Starhill Global REIT depends entirely on which metric you track. Its unit price sits in negative territory for the year, but when you add in cash distributions collected, the 12-month total return turns positive. The underlying earnings tell a more cautious story for Starhill. Net income dropped sharply compared to the previous period, even as sales held up. A trust can maintain distributions temporarily, while earnings compress, which demands close monitoring. Headline growth figures at Frasers Centrepoint Trust look impressive on the surface. Top-line revenue and net property income both expanded by roughly 20%, but nearly all of that lift came from absorbing North Point City South Wing mid-period. Existing malls grew revenue by less than 2%. More units on issue means each unit holder gets a smaller slice of that expansion. Total distributions paid out rose roughly 14%, but units in issue grew 12% to fund the deal, leaving net distribution per unit up just 1.4%. Centrepoint Trust remains a solid suburban retail landlord anchored near residential heartlands. Suburban footfall holds resilient through macro shifts. But unit holders need to look at distribution growth per unit rather than headline portfolio expansion. I used to think a REIT's revenue growth and her own distribution growth were basically the same thing, just one measured in dollars and the other in cents per unit. This name taught me they are not. A trust can buy its way to a bigger, more impressive-looking business while diluting what each existing unit actually earns, simply because more units now exist to share the same growing pie. It is not dishonest. The acquisition is real and disclosed. But it changes the question worth asking. Is this making your units worth more or just making the trust bigger? 6 names, 6 different years. A rebrand born out of real difficulty. A REIT whose price fell while its actual payouts grew. A REIT where the right answer to how it did this year genuinely depends on which question you are asking. And a REIT that grew its business by buying a bigger one without growing each unit slice of it by nearly as much. Retail REIT turns out to be a description of what these trusts own, not a description of how they are doing. Treat each one on its own filings rather than as a single basket. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a licensed financial advisor before committing funds.
Unlocking the future of finance. Subscribe for more.